Welcome back to The Explainer. Okay, today we're diving into what is honestly one of the most fascinating financial detective stories out there right now. We're looking at a company called CORZ, ticker symbol COZZ. If you follow the markets at all, you know that every now and then you stumble across a stock profile that just completely defies logic. Like a massive market paradox where the headlines point one way, but the actual underlying mechanics point in the exact opposite direction. That's exactly what we have going on here. Now, our goal today isn't to tell you whether this stock is a buy or a sell. We're just going to dissect this anomaly using the company's own raw data. To figure this out, we're going to hit 5 key areas. We'll look at the wild market ride, how the stock is priced, compare revenue versus income, dig into profitability and cash flow, and finally, look at the fundamental paradox tying it all together. All right, Section 1. The wild market ride. From wipeout to the stratosphere. 14,444.51%. Yeah, you heard that right. That is Core Scientific's yearly return for 2024. In the financial world, seeing a return in the thousands is crazy enough, but pushing past 14,000% in a single calendar year, it's literally astronomical. That unprecedented surge is what rocketed the company's valuation to a massive $6.4 billion market cap today. And this perfectly captures the roller coaster we're talking about. Look back at 2022, a near total wipeout, right? Negative 99.31%. But then it kind of stabilized with a 28% return in 2023, right before that absolute gravity-defying 14,000% explosion in 2024. And it's still going. We're seeing a 3.63% return in 2025 and a nearly 40% trajectory tracking into early 2026. The market has aggressively bought into this massive comeback story. Moving on to Section 2. Valuation, pricing the stock, peeking under the hood of a $6.4 billion giant. So let's look at how the market is actually pricing this thing, starting with the classic price to earnings, or PE ratio. The trailing PE sits at 15.19. Honestly, on its own, a 15 PE is pretty reasonable. You're basically paying $15 for every dollar of past earnings. But take a look at the forward PE. It shoots all the way up to 156.25. Since forward PE looks at projected future earnings, a massive jump like this means the market is pricing in some seriously sky-high expectations. People are paying a huge premium for what they think the company will do, not what it's actually done recently. But things get a lot murkier when we look at a couple of other standard valuation metrics. We've got a price-to-book ratio of negative 6.64 and an enterprise value to EBITDA of negative 66.60. Just to translate the jargon here a bit, book value is basically the net asset value of a company. So a negative PB ratio means the company is operating with negative equity. Its liabilities are literally outweighing its assets on the balance sheet. And EBITDA measures core operational earnings. A negative EV to EBITDA, that means negative core earnings. So despite being valued at $6.4 billion, structurally, the company is carrying a massive, negative load. It's kind of like a rocket ship trying to take off while tied to a financial anvil. Section 3. Growth. Revenue versus income. The central paradox of CORZ. This is where our detective story gets super weird. Check out this massive disconnect. Trailing 12 months revenue growth is down 37.53%, so the actual top-line money coming in the door from operations is shrinking fast. But then, somehow, trailing 12 months net income growth is up nearly 143%. Let that sink in for a second. How exactly does a business with sales contracting by almost 40% manage to grow its bottom-line income by 143%? That right there is the central paradox of CORZ Scientific. It really forces us to stop and ask a very serious question. Beneath the skyrocketing stock price and whatever complex accounting is driving that net income growth, is the underlying business actually profitable? To find the truth, we have to strip away the hype and look at the hard, physical reality of the company's operations. Which brings us to Section 4, profitability and cash flow, the cost of the comeback. To get to the bottom of this, we have to look at the actual cash. And when we check the net profit margin, well, it's a pretty stark reality check. The margin is deeply in the red at negative 55.22%. That means for every single dollar Core Scientific brings in, they're losing more than 55 cents. So that massive 143% income growth we just looked at, which, can often get skewed by debt restructuring or one-time accounting tweaks, the day-to-day operational profit margin is still intensely negative. But hey, margins are just percentages. If we really want to understand survival, we need to talk about free cash flow. Just as a quick refresher, free cash flow is the actual, tangible cash left over after a company pays for its operations and maintains its capital assets. It's the lifeblood of the business. You can't pay debts or invest in new gear without it. Honestly, anytime you're looking at a hype stock, this is the very first metric you should check. And this brings us to the most sobering number in the whole dataset. Negative $450.75 million. That is CORZ Scientific's trailing 12 months free cash flow. They are bleeding nearly $500 million in cash over a 12-month period, just to keep the lights on. It is a staggering operational cost to fuel this comeback narrative that the market has been rewarding so generously. Finally, Section 5, the fundamental paradox. Reconciling the boom and the burn. Let's put all the puzzle pieces together here to summarize this incredible financial autopsy. We've basically got two totally distinct realities running in parallel. Over in the bull case corner, you have a stock that literally rose from the ashes, a 14,000% return in 2024, a formidable $6.4 billion market cap, and technically a 142% growth in net income. It's the ultimate story of triumph. But then, right next to it is the bear case, a business where actual top-line revenue shrunk by over 37%, operating at a massive negative 55% net margin, and burning through nearly $500 million in free cash flow. It's this wild juxtaposition of explosive market sentiment versus highly sobering operational realities. Which leaves us with the ultimate question. Look, in the financial world, momentum and belief are incredibly powerful forces. I mean, they can revive a company from a 99% wipeout and shoot it straight into the stratosphere. But eventually, the bill comes due. Can market sentiment outrun a negative $500 million cash flow forever? That's the real anomaly of CORZ Scientific, and it is going to be a fascinating reality to watch unfold. Thanks for hanging out with me on this deep dive. Keep questioning those numbers, and I'll see you in the next explainer.